Please like, share, and subscribe. Wishing you happiness and good luck every day.
Hey, welcome. If you've ever listened to people talk about the stock market and just felt totally lost, like they were speaking another language, well, you've come to the right place. We're going to cut through all that noise and make the world of investing make sense. Okay, let's just jump right in. So I want to start with a question, just for you. Take a second and really think about it. Do you see yourself as an investor? You know, for a lot of us, the answer is probably no way. It sounds like a job for Wall Street types or for people who just have tons of money lying around. But what if I told you that's not really the full story? Yeah, you heard me right. Surprise? You're already an investor. And I'm not just saying that to be nice. The truth is, you make investments all the time, every single day, whether you even realize it or not. So let's actually connect those dots. In this first part, we're going to see how the basic idea of investing is something you're already a total pro at. I mean, think about it, right? When you're training for a marathon, you're investing your time and a whole lot of sweat into your future health. When you spend your weekends with your kids, you're investing in those family bonds. When you take night classes to get a degree, you're investing in your career. See the pattern? In every case, you're putting in resources now for a better payoff later. So when we start talking about financial investing, guess what? It's the exact same idea, just with money. The goals are things we all get, building enough wealth to live comfortably, supporting your family, and setting yourself up for a really solid retirement. It's all about using your money today to build a better tomorrow. All right, now that we're all on the same page about what investing really is, let's talk about the single biggest thing that trips up new investors: expecting the impossible. This is where we get to the golden rule of this whole game. Come on, be honest. Have you ever thought something like this? It's super common. We all want those amazing, high-flying returns without any of the stomach-churning stress or, the chance of actually losing money. But the financial world, it just doesn't work that way. It's kind of like saying you want to eat nothing but bratwurst and pizza, but you're expecting the health benefits of a super high-fiber, low-calorie diet. You just can't have it both ways. It's an impossible trade-off, and chasing it will only lead you to make some bad calls. And what's so cool about this chart is how perfectly it shows you this relationship. Just look at the bars. Over on the far left, you've got treasury bills. See that little light gray bar? That's the return. It's tiny. But the dark gray bar next to it, the risk, is also tiny. Now, slide your eyes all the way to the right to small company stocks. Whoa, the return bar is huge, but look at that risk bar. It's even bigger. You can literally see the trade-off right there on the screen. So here's the absolute bottom line. This is the bedrock of all investing. If you only remember one thing from our time together, make it this. High risk comes with the potential for high returns. Low risk comes with the reality of low returns. Getting that in your head is probably the biggest first step you can take to becoming a smart investor. Okay, I know what you might be thinking. Risk, volatility, that all sounds a little scary. But don't worry. As a new investor, you actually have a secret weapon, an incredibly powerful ally that does most of the heavy lifting for you. And there it is, your best friend, time. Just look at that curve. See how it starts out kind of slow, almost flat for a while? But then, over the years, something pretty magical starts to happen. The growth just takes off, and that line shoots up like a rocket. That is the incredible power you have on your side, especially the earlier you start. Now, that magic has a name. It's called compounding. It's the simple idea that the money your investments earn starts to earn its own money. It's a snowball effect. You start with a small snowball at the top of a very long hill, and by the time it reaches the bottom, it's a giant boulder. And check this out. Here's a really cool, simple trick to help you picture this. It's called the Rule of 72. All you do is take the number 72 and divide it by your expected annual growth rate. The answer is roughly how many years it'll take to double your money. So if your investments are growing at 8% a year, your money will double in about 9 years. But at 12%, it only takes 6 years. It just goes to show you how a seemingly small difference in your return rate can have a massive impact over time. Okay, so we've got the big ideas down. Now let's get really practical. We're going to finish up here with a quick fire round to answer the top 3 questions that stop most people from ever getting started. This is a big one. So many people have this idea that you need like a briefcase full of cash just to be allowed to buy a single stock. Well, the truth is, you can start with way less than you think. Even $1,000 is more than enough to get in the game. Now, yeah, as this shows, if you pay a $10 trading fee, that's a bigger percentage of a small portfolio. But honestly, the most important thing is just to begin. Starting small is infinitely better than never starting at all. And over time, as you add more money and your investments grow, those fees become a tiny, tiny fraction of the whole thing. Okay, here's another classic trap for new investors. You see a stock that's trading for, say, $5 a share, and another one that's $500 a share. It's so tempting to think the $5 one is the better deal, right? But is it actually cheaper? Let's be really clear about this. A low share price does not mean a stock is a bargain. Value isn't about the sticker price, it's about what you get for that price. Take a look at this. Stock A costs $100 a share. Stock B is only $50. Your first instinct is probably to grab stock B, right? It's half the price. But hold on. Look at the earnings. Stock A earns $10 for every single share. Stock B only earns $2.50. That means for stock A, you're paying 10 times what it earns. For stock B, you're paying 20 times what it earns. So which one is actually cheaper? It's the $100 stock. It's literally twice the value. And that brings us to the final million-dollar question. Once you get the basics and you're ready to put your money to work, how in the world do you actually choose? How do you pick the winners out of thousands of options? Look, answering that question is a whole other journey. But just by getting this far, you've built an incredible foundation. You understand what investing really is, you know the golden rule of risk and return, and you've seen the unbelievable power of time. You're not just ready for the next step, you're ready to start building your future.
Let's talk about investing, but probably not in the way you're used to thinking about it. We're not going to get bogged down in a bunch of crazy charts or complicated jargon. Instead, I'm going to show you that investing, well, it's something you're actually already an expert at, even if you don't know it yet. So let's dive in.
So, I have a question for you, right off the bat. What are you investing in? I mean, right now, today. If your brain immediately jumped to stocks, or maybe your 401k, just hold that thought for a second. Because I bet the real answer is a whole lot closer to home, and it's something you've been doing your whole life.
For instance, if you spend your weekends training for a marathon, or hey, even just making sure you get out for a walk, you're not just exercising. You're making a really smart investment in your future health. You're tipping the odds in your favor for a happier, more active life down the road.
Or what about this? When you spend your Saturdays at your kids' soccer games, or maybe just exploring a museum together, that's a huge investment. You're pouring your time into building strong relationships, the kind that will support and enrich you for years and years to come.
And if you're slogging through night classes or spending your evenings working on a new certification, that is a direct, hands-on investment in your career. You're putting in the hard work now to unlock better jobs and, let's be honest, a bigger paycheck later on.
You see what I mean? Whether it's your time, your energy, or your focus, we are all constantly making investments. And every single one of them has the same powerful goal, to build a better future. Financial investing, it's just one more tool you can put in that toolbox. So, when we start talking about investing money, the very first step is exactly the same. You have to find your why. What kind of future are you trying to build? Knowing your motivation, well, that's everything. It's your North Star.
And you know, most of the time, our motivations fall into one of three big buckets. Maybe you're looking to build wealth right now for a more comfortable life. Or maybe you're focused on supporting your family. You know, the house, college tuition, all of it. Or perhaps you're taking the really long view, and it's all about setting yourself up for a secure, fun retirement. Take a second and think about which one of those really speaks to you.
Okay, so once you've got your why, the next step is a big one. It's time for a reality check. Because the single biggest mistake new investors make isn't picking the wrong stock. Nope, it's not understanding the fundamental rules of the game.
Financial advisors hear this all the time. I want annual returns of about 20%, but I don't want to take much risk. I mean, on the surface, who wouldn't want that deal? It sounds amazing. But the thing is, it's just not how investing works. At all.
Making that request is kind of like going to your doctor and saying, hey, I want a diet of nothing but bratwurst and pizza, but I need it to be super high in fiber and really low in calories. It just doesn't compute, right? The two ideas completely contradict each other.
And this isn't just an opinion. We've got the data to prove it. Take a look at this chart. That gray bar shows the average yearly return for different investments. The black bar shows the risk, basically how much the value can swing wildly up and down. So, way down at the bottom, you've got treasury bills. Super safe, barely any swing. But look at that return, pretty modest.
Now, let your eyes travel all the way to the top to small company stocks. The return is huge, but whoa, look at that risk bar. It's gigantic. That means you could have some incredible highs, but also some really gut-wrenching lows. So this brings us to the most important point. Seriously, if you forget everything else, please burn this into your brain. It is the absolute cornerstone of investing. High risk, high potential return. Low risk, low potential return. There is simply no such thing as high return with low risk. It does not exist.
All right, now that we've got that fundamental rule down, we can get to the fun part. We can move from theory into action. It's time to actually build a plan that's tailored for you by setting goals you can actually reach.
So how do you do that? Well, it all starts by asking yourself 4 pretty simple questions. First, what are my goals? And I mean get specific. Get rich isn't a goal, it's a dream. Retire with $1 million? Now that's a goal. Second, how long do you have? Your timeline is crucial. Investing for 10 years is a totally different sport than investing for 40. Third, and be honest with yourself here, how much risk can you stomach? How much of a roller coaster ride can you handle before you panic? And finally, what do you actually have to do to make all of this happen?
Now, to help you with that last question, I want to give you a really simple but incredibly powerful little mental trick. It's called the Rule of 72. And all you have to remember is that one number, 72.
Here's how it works. You just divide 72 by your expected annual return, and that tells you roughly how many years it'll take for your money to double. So if you're getting a 4% return, it'll take about 18 years. But if you can get an 8% return, it only takes 9 years. See? This simple little rule helps make those big, far-off goals feel a lot more real and achievable. Okay, I know this can all feel a little overwhelming. You might be looking at the gap between where you are now and where you want to be, and it can feel pretty big. But I promise you, you have an incredibly powerful ally on your side, and it's something that every single one of us has.
That ally is time. Just look at this chart. For the first 10, even 20 years, the growth is, okay, it's steady, kind of boring, honestly. But then look what happens. Something magical kicks in, and that curve just shoots for the sky. Why? Because you're not just earning returns on your original money anymore. You start earning returns on your returns. And that's where the real magic happens.
This amazing force is called compounding. It is the engine of creating wealth. Think about it. Earn 10% on $10,000, and you get $1,000. Cool. But the next year, you're earning 10% on $11,000. It's a small difference at first, but over decades, those little extra gains on top of your gains, they snowball into an absolute fortune.
And that really brings us to the single most important takeaway from all of this. If you want to let compounding work its magic for you, you have to give it what it needs most. Time. A lot of time. You can't just wait around for the perfect moment to start. The cost of waiting is way too high. You know, they say the best time to plant a tree was 20 years ago. The second best time, it's right now.
Look, at the end of the day, investing is really just another word for planning. It's about taking clear, intentional steps today to build the life you want tomorrow. Your future is out there, waiting for you. The only real question left is, what are you going to do to meet it?
Let's talk about the stock market. You know, it can feel like this super complex world that's only for the experts, right? But what if I told you it's actually way simpler than you think? Our goal here is to cut through all that confusing jargon and give you a clear, simple guide to get you started. So, let's dive in.
Have you ever just looked at the financial news and felt completely lost? Yeah, you are definitely not alone. It's a world that seems filled with confusing language and charts that move a mile a minute. But honestly, the core ideas behind it all are much, much simpler than they look. And that's what we're here to do. We're going to break it all down, step by step.
So, to really get a handle on what the stock market is today, you kind of have to know where it came from. Let's take a quick trip back in time and see how this whole thing got started.
Believe it or not, the basic idea of a stock market is over 400 years old. It all started when a Dutch company needed cash to grow its shipping fleet. So, what'd they do? They sold tiny pieces of ownership. We call them shares to regular people. That idea led to the very first stock exchange in Amsterdam. Fast forward to 1792 in America, a group of brokers literally met under a tree, a buttonwood tree, to hash out some rules for trading. And that simple agreement, that became the New York Stock Exchange, which, along with tech-heavy markets like the NASDAQ, is the center of the trading world today.
So these are the big leagues, the main arenas where all the buying and selling goes down in the US. You've got the NYSE, that's the big old school powerhouse. Then there's NASDAQ, which you probably know as the home of huge tech companies like Apple and Microsoft. And you've also got NYSE MKT, which is a place that focuses on smaller companies. And these things called ETFs, which are basically just baskets of different stocks you can buy all at once. All right, so much for the history lesson. Let's get down to the practical stuff, right? This next part is all about answering those questions that every single beginner has, from how in the world do I even start to how much money do I actually need. And here's the good news. Getting started is way more straightforward than you might think. It really just boils down to these 4 simple steps. First, you pick a broker. They're like the gateway to the market. Second, you hop on their website and fill out a quick application. Third, you transfer some money into that new account. And that's it. Seriously, you are officially ready to invest.
Okay, let's tackle a huge myth right now. This idea that you need a fortune to start investing. You just don't. I mean, sure, having more money helps you buy different things faster, but you can absolutely start your journey with $1,000 and sometimes even less. The most important part isn't the amount you start with, it's just starting.
Okay, but what about fees, you're probably asking? Let's talk about commissions. When you buy a stock, your broker takes a small fee for making the trade happen. Now, look at this chart with me for a sec. If you invest $1,000 and the commission is $10, that's 1% of your investment. But check out what happens when your portfolio grows to, say, $100,000. That same $10 fee is now a tiny, almost invisible fraction of your money. Here's the bottom line. The cost of not getting in the game is usually way, way higher than these small entry fees. Don't let them stop you.
And here is another totally outdated idea we need to throw right out the window. You know, decades ago, back in the old days, people used to buy stocks in big blocks of 100 shares. But thanks to modern electronic trading, that whole idea is completely irrelevant now. You can buy 87 shares, 42 shares, or even just a single share. The focus today isn't on how many shares you buy, it's about the dollar amount you're comfortable investing.
In this right here, this is maybe one of the most important ideas for any new investor to grasp. Price is not the same thing as value. A $100 stock might seem more expensive than a $50 stock, right? But let's dig deeper. If that $100 stock's company is earning $10 per share, you're paying $10 for every $1 of earnings. But what if the $50 stock's company only earns $2.50 per share? Well, then you're paying $20 for every $1 of earnings. So in that case, the cheaper stock is actually twice as expensive from a value perspective. It's not about the price tag, it's about what you're actually getting for your money.
Okay, so you've opened your account, you get the basics. Now for the really fun part, the strategy. How do you decide what to buy, when you should sell, and how to balance the whole thing?
Need a really simple starting point for balancing your portfolio? Here's a classic rule of thumb. Just take the number 110 and subtract your age. That number you get is a good baseline for the percentage of your money you might want to have in stocks, with the rest in safer things like bonds. So if you're 30, you're looking at maybe 80% stocks. If you're 80, you're looking at 30%. Now, it's just a guideline, not a hard and fast rule, but it's a great way to start thinking about adjusting your risk over time.
So when you're trying to pick a specific stock, it helps to run it through these 5 key questions. First, is it a good value for what you're paying? Second, can the company actually grow its profits over time? Third, is that growth profitable? Are they making money? Fourth, what's the general story out there? What are people saying? And finally, the most personal and maybe most important question, can you sleep at night owning this stock? If owning a certain company is going to stress you out, it's probably not the right fit for you, no matter how good it looks on paper.
So you bought a stock you really like. Does that mean you just hold on to it forever? Well, not necessarily. This chart right here, it shows the 2008 financial crisis, and it's a really powerful reminder of why buy and hold forever isn't always the best advice. You can see that while the whole market took a hit, bank stocks got absolutely hammered. The entire world changed for that industry, and it shows why you can't just stick with an investment if the reasons you bought it in the first place just aren't true anymore.
So when is it a good idea to sell? You want to avoid emotional decisions, so here are 4 really logical, unemotional reasons. 1, your original reason for buying is gone. The compass has changed direction. 2, the company itself has changed in a major way. The puzzle pieces just don't fit anymore. 3, the entire industry is in trouble. The bridge is broken. And finally, the most practical reason of all, you hit your goal and you need the cash for whatever you were saving for, like tuition or a down payment.
Okay, we've talked about the what and the how. But now we need to talk about what might be the most powerful tool you have in all of this, and that's your own mindset. The psychology of investing is every bit as important as the numbers. You know that feeling, right? You check your stocks, one is down, and there's no bad news, no announcement, nothing. It's confusing. But this quote really explains it. The market is just a giant collection of human feelings and opinions.
And sometimes a stock drops simply because more people decided to sell than to buy that day. Maybe they were taking profits, maybe they were just nervous about the economy. A lot of the time, it has nothing to do with your specific company at all.
Now, this idea of focusing on market mood and price charts leads to a whole school of thought called technical analysis. It's all about trying to predict where a stock will go next by looking at past patterns on a chart. It's a whole different ballgame from what we've been talking about, and honestly, it's something beginners should be pretty cautious about.
And that really leads to a super important piece of advice. Trying to time the market, waiting for a stock to dip just a little bit more before you buy, it's pretty much a losing game. It is incredibly difficult, even for the pros. If your homework tells you a company is a strong investment at its current price, the risk of it going up without you while you wait is often way bigger than the chance you'll perfectly nail the bottom.
So there you go. The stock market isn't some secret exclusive club. It's a tool built on principles that you can absolutely understand and use to build your own financial future. We've laid out the fundamentals, the starter pack, the strategies. You literally have the map in your hands now. So the only real question left is, where are you going to go first?
All right, let's dive right in and crack open what we're calling the investor's toolbox. If you hear terms like stocks, bonds, or ETFs and your brain kind of just shuts down, don't worry, you're in the right place. We're going to spend the next few minutes breaking down the 5 essential types of investments that pretty much everyone should know about. Simple as that.
I absolutely love this quote from our source material because it's just so real. If you've ever felt like the whole world of finance is speaking a totally different language, well, this is for you. We're going to get you fluent. I mean, it is. It's this giant wall of jargon, and it's so easy to just feel completely overwhelmed. You hear about people making all this money in the market, but taking that first step can feel like trying to jump across the Grand Canyon. So yeah, where do you even begin?
Well, let's try to look at it a different way. Instead of some confusing, scary mess, let's think about it like you're building a toolbox. That's it. Every single investment is just a tool. And each tool has a specific job, a certain amount of risk, and, of course, a potential reward. Our goal today, it's just to get you familiar with the basic tools that every single investor needs to know about.
Every good project, every good building, it needs a solid foundation, right? Well, in investing, that foundation is built with tools that are all about safety and generating some predictable income. These are your low-risk, super reliable starting points.
Okay, first up, the simplest tool in the whole box, the certificate of deposit, or a CD. And nope, not the kind you played music on. With a financial CD, you're basically just loaning a bank your money for a set amount of time, say a year. And in return, they pay you a fixed interest rate that's almost always better than what you'd get in a regular old savings account.
But here's the deal. There's always a trade-off. What this slide shows is that a CD is about as safe as it gets. Your money is literally insured by the government. But the downside? Well, you're not going to get rich off of them. The returns are low and your cash is locked up until that term ends. So it's really the price you pay for some serious peace of mind.
So, let's move on to bonds. Now, if a CD is you lending money to a bank, a bond is you lending money to a huge corporation. Think Apple or a big utility company, or even to the US government itself. You give them your cash, they pay you regular interest, and then at the very end you get your original loan amount back. In this scenario, you get to be the bank.
And this right here, this is probably one of the most important concepts in all of investing. You have to get this straight. With a stock, you own a tiny piece of the company. You're an owner, so your success is tied to the company's success. But with a bond, you're just lending money to the company. You're a lender. Your return is just that fixed interest they promised you. It's a difference between being a partner in the business versus just being a creditor.
So the bottom line on bonds is this. They are fantastic for creating a predictable, steady stream of income. And yeah, they're generally way less volatile than stocks. But that safety comes at a cost. They usually don't have that high growth potential that stocks do. Plus, you kind of have to do your homework to make sure the company or government you're lending to can actually pay you back. Okay, so we've laid our foundation. Now it's time to talk about the real engine of your toolbox. We're talking about the tools that are designed for real, long-term growth. It's time to talk about stocks.
So like we just said, when you buy a stock, sometimes called an equity, you are buying a small slice of ownership in a public company. That means you have a claim on everything the company owns and all the profits it might make in the future. So if that company does well, if it grows, the value of your little slice of ownership grows right along with it. This is how most people build serious wealth over the long haul.
But here's the thing, not all stocks are the same. You've basically got two main flavors. You have value stocks. These are often solid established companies that, for whatever reason, look like they're on sale. And then you have growth stocks. These are the exciting companies that everyone expects to expand like crazy. You could think of it as buying a reliable, sturdy pickup truck versus buying a flashy new sports car. Both can get you there, just in very different ways.
And this data here, it tells such a great little story. Look at 2008, during the big financial crisis. Everything got hammered, but value stocks actually fell way harder than growth stocks. Ouch! But then, look at the very next year, 2009. The rebound. Value stocks came roaring back even stronger than growth stocks did. It's just a perfect little reminder that different tools work better in different environments. There's no single best answer all the time.
And stocks don't just have different flavors, they come in different sizes too. You have your large caps. These are the giants, the huge, household names you know and love. They're kind of like aircraft carriers. They're stable, they're powerful, but they turn really slowly. Then you have small caps. These are smaller, nimbler companies with a ton more room to grow. Historically, they give you higher returns, but they're also way riskier. They're more like speedboats in a storm.
So, what's the big takeaway for stocks? It's this. They give you the absolute best shot at high returns over a long period of time. But that potential for reward comes with a price, short-term volatility. The prices can swing like crazy, and you really do have to pay attention. This is the power drill in your toolbox. It can do amazing things, but you have to handle it with respect.
Okay, so we've talked about the individual tools, the hammer, the screwdriver, but what if you don't want to go out and buy every single tool one by one? What if you could just buy a prepackaged kit that has everything you need? Well, you can. Let's talk about funds.
So just imagine this for a second. Let's say you have $10,000 and you want to invest it. You've heard that it's super important to diversify. Don't put all your eggs in one basket. So you decide you're going to buy 50 different stocks. How would that even work?
Well, it would be a complete nightmare. Seriously, you'd have to research every single one of those 50 companies, then you'd have to place 50 separate trades, and you'd probably pay a commission fee on every single one. It's just a huge hassle, and for most of us, it's not realistic at all.
But thankfully, there is a much, much easier way. And that is the exact problem that mutual funds were invented to solve. A mutual fund just pulls money from thousands of people, just like you, and then a professional manager uses that giant pot of money to buy a whole bunch of different stocks or bonds. So with one single purchase, you get instant diversification. It's a game changer.
Now, a more modern and super popular version of this idea is the Exchange Traded Fund, or ETF. Just think of an ETF as a close cousin to a mutual fund. It's still a big basket of investments, but the main difference is that it trades on a stock exchange all day long, just like a single stock does.
So what is the actual difference then? Well, it really comes down to how they trade. A mutual fund's price gets calculated just once a day after the market closes, but an ETF's price is changing constantly, all day long. The other huge difference is that most ETFs are passively managed, which is just a fancy way of saying they're built to automatically track a market index, like the S&P 500. This hands-off approach often makes them a really simple and really low-cost choice.
All right, you've now seen all the essential tools for your investor's toolbox, from the safety-first options like bonds all the way to the convenience of funds. But just having the tools is only half the battle. Now we need to talk about the right mindset for actually using them.
Look, you're going to make mistakes. Everybody does. The legendary investor Warren Buffett said it best. When the market is going up and up, everybody looks like a genius. It's only when things get tough, when the tide goes out, that you find out who is just getting lucky and taking foolish risks. The goal isn't to never make a mistake. It's to understand what your tools do and to avoid just chasing whatever is hot at the moment. So there you have it. You've got the blueprints now. You understand the foundational tools, from the rock-solid stability of a CD to the growth engine of stocks to the instant diversification of an ETF. The next step is all about learning how to combine these tools to build something that actually helps you reach your goals. So really, the only question left is, what are you going to build?
You've heard it a million times, right? The first rule of investing is buy low, sell high. Sounds easy enough, but how in the world do you know when a stock is actually low? Well, that's exactly what we're going to tackle here. We're going to start building a foundational toolkit to help you figure that out. So, you ready? Let's dive in.
The crazy thing is, the hard part isn't even the math. It's all in your head. As our source material puts it, buying low often feels like you're jumping into a pool just as everyone else is desperately trying to get out. It just feels wrong.
And look, that fear, it's totally justified. Because when everyone is running for the exits, you have to ask yourself a really important question. Are you seeing a golden opportunity that nobody else does? Or are you just the last one to spot the shark in the water?
So what's the secret to telling the difference? Well, it's not about being some fearless daredevil. It's about knowledge. It's about having the tools to figure out what a company is really worth all on your own so you can act with confidence no matter what the crowd is doing.
Okay, so how do we get that knowledge? We build a toolkit. And today, we're adding the first 4 essential tools to your valuation toolkit. Each one gives you a different way to look at a company, to see its value from a critical new angle.
All right, here they are. The first 4 tools we're going to pop into your new toolkit. We've got the PE ratio, that's price to earnings, the PS ratio, or price to sales, the PB ratio, price to book, and finally, the POCF ratio, which is price to operating cash flow. Let's start with the most famous one of the bunch.
Okay, first up, the price to earnings ratio, or just PE for short. If you've ever heard people on TV talking about whether a stock is cheap or expensive, this is almost always what they're talking about. It's the most popular tool in the box, and for good reason.
So what is it exactly? Well, it's pretty straightforward. It just compares a company's stock price to how much profit it's making. Think of it this way. The PE ratio answers the question, how many dollars are people willing to pay right now for every single dollar of this company's profit? It's a really logical place to start.
All right, let's get our hands dirty and see how this works. We're looking at data for the big drug company, Pfizer. All we need are 2 numbers from this chart. First, the share price. You can see it right there, $28.21. And second, the profits per share, which is $2.10. You just divide the price by the profits. So $28.21 divided by $2.10 gives us, bam, 13.4. That's Pfizer's PE ratio. Okay, great. But, and this is a huge but, what on earth does that number even mean? And this right here, this is probably the most important rule you're going to learn today. A ratio by itself is totally useless. It's just a number floating in space. You absolutely must compare it to other companies in the exact same industry. Trying to compare a tech company's PE to a railroad's PE is like comparing apples to, well, to locomotives. It just doesn't make any sense.
And boom, this is where it all clicks. When we put Pfizer's 13.4 next to its direct competitors, the picture becomes crystal clear. You can see it's right in the same ballpark as Eli Lilly and Merck. But now look at Bristol-Myers Squibb, 24.1. Whoa! All of a sudden, it looks way more expensive than the others. See how powerful that simple comparison is?
Now, like any tool, the PE isn't a magic wand. You got to know its limits. For one, those earnings can sometimes be fudged with accounting tricks. 2, it's totally useless for companies that are losing money because, you can't divide by 0 or a negative number. Also, a higher PE might just mean investors expect the company to grow really fast. And that super low PE, it could be a bargain, or it could be a sign that the company is in deep, deep trouble.
See, that's exactly why one tool is never enough. You need a whole toolkit to get the job done right. So let's add 3 more tools that'll give us different angles on a company's value and let us double check what the first tool is telling us.
All right, tool number 2 is the price to sales ratio, or P to S. This one's a little different. It compares the company's price to its total sales, its revenue. So instead of profits, we're looking at the top line number. It basically asks how much are we paying for every dollar in sales this company brings in.
So what's the big advantage here? Well, remember how the PE ratio is useless if a company's losing money? The PS ratio doesn't have that problem, because pretty much every company has sales, even if they aren't profitable yet. That makes this tool incredibly useful for checking out younger, fast-growing companies.
Okay, tool number 3 takes us to a different financial statement, the balance sheet. It's called the price-to-book ratio, or P/B. This compares the stock price to the company's book value, which is just all its stuff, its assets minus all its debts, its liabilities. You can kind of think of it as a rough estimate of what would be left over for investors if the company shut down and sold everything off.
So, when do you pull this tool out of the box? Well, it's great for companies that own a lot of physical stuff. Factories, machinery, real estate. It's not as helpful for a company whose main asset is something you can't touch, like a famous brand name or a software patent. But it's always a fantastic way to cross-check what your other tools are telling you.
And that brings us to our last tool for today. And honestly, it's a favorite for a lot of pros. It's the price to operating cash flow ratio, or POCF. This one compares the company's price to the actual cold hard cash that its main business is generating.
Now, why do so many people love this one? Well, they call it the cleanest ratio. And the reason is simple. Cash is king, right? It's much harder to fake cash flow with accounting shenanigans than it is to fudge reported earnings. Cash is either in the bank or it isn't. It gives you a really clear view of a company's health.
Okay, we've done it. We've got our first 4 tools. But just having a hammer doesn't make you a master carpenter, right? Knowing how to use these tools wisely, together, that's the real craft of valuation.
And here's the big takeaway from all this. Years and years of research show that stocks with low valuation ratios, like the ones we just talked about, tend to do better than expensive stocks over time. But I want you to really focus on that one word, tend. It is not, and I repeat, not a guarantee.
Look, investing isn't about being perfect. You're never going to be right 100% of the time. As the source material says, you can't avoid all the stinkers. You just need to find enough winners to offset your losers. This is about playing the odds, about tilting the game in your favor. It's not a crystal ball.
And this right here is the real secret. The goal isn't to find the one perfect tool. It's to use them all together. Does the stock look cheap based on its earnings? Great. Now check. Does it also look cheap based on its sales? What about its book value and its cash flow? When you use them all in combination, you start to build a complete 3D picture. And that's how you make a truly informed decision.
So, there you have it. Your toolkit now has its first 4 essential pieces. You now have what you need to cut through the market noise, to ignore the panic and the hype, and to start seeing a company's real value for yourself. The only question left is, what are you going to build with them?
All right, so you're staring at the stock market, and it feels like a giant, unsolvable puzzle, right? The biggest question of all, how in the world do you pick a winner? Well, today, we're going to crack that case. So put on your detective hat because we are going on the hunt for the one clue that changes everything.
I mean, this is it. This is the big one. The question every single investor asks. You've got thousands of companies out there. So how do you find that one, that needle in a haystack, that's ready to take off? Is it some kind of gut feeling, a hot tip from a friend? Or is there a better way, a system?
Well, the secret, it's actually pretty simple. If you really want to know where a stock's price is headed, you've got to follow the money. And that trail, it almost always leads back to one thing, growth. You see, a company's power to grow its sales and its profits, well, that's the engine that drives its stock price up.
So here's our game plan, our case briefing for today. First, we're going to zero in on our prime suspect, growth. Then we'll get our detective's toolkit ready and figure out where to gather the evidence. After that, we crack the numbers, connect the clues, and finally, we'll deliver a verdict on a real-world company.
Okay, let's get into it. Section 1, our prime suspect. Why is growth the absolute #1 clue we should be looking for when we're investigating a stock?
Let's make this super simple. On the left, you've got a company that's just stuck. Sales are flat, profits are flat, and guess what? The stock price is flat. It goes absolutely nowhere. But on the right, that company is growing. As its sales and profits climb, the company itself becomes more valuable. And that value, it translates directly into a higher stock price for you. It's really that straightforward.
All right, we know what we're hunting for. Now we need the right tools to find it. So in Section 2, we're opening up the detective's toolkit to pull out the 6 essential clues that are going to lead us right to the truth.
These are our 6 go-to pieces of evidence. Think of it this way. We've got clues about what's happening right now, like quarterly growth. We've got clues about the long-term history, which shows us the bigger pattern. And maybe the most important part, we've got clues about the future, what the experts are predicting. You see, no single clue tells the whole story, but when you put them all together, that's when you build a really powerful case.
Now, a great toolkit doesn't do you any good if you can't find the evidence in the first place. So in Section 3, we're going straight to the source. I'm going to show you exactly where to find these numbers so you don't get lost chasing down bad leads. And listen, you don't need some secret insider connection for this. All this evidence is hiding in plain sight. You just head over to a company's website and look for a section called Investor Relations or sometimes just IR. That's where you'll find the official documents, the earnings releases, and the SEC filings. This is the raw data, the real evidence you need for your investigation.
Now, here's a trap a lot of people fall into.
They grab the newest report and they compare it to the one from 3 months ago. Seems logical, right? I mean, it's the most recent data. But this is a classic rookie mistake, and it can send your investigation completely off the rails. So why is that?
The answer is one word: seasonality. You know, just like we have summer and winter, a lot of businesses have their own seasons. Think about it. Retailers make a killing during the holidays. A company that sells snowblowers is going to do great in the winter. So if you compare a strong season to a weak one, you get a totally false picture. The only way to get the real story is to compare this quarter to the same quarter from last year.
And this right here is a perfect example. Just look at the profits for Macy's. Every single year, like clockwork, that January quarter, which covers all the holiday shopping, it's huge. It's often bigger than the other 3 quarters put together. So if you compared April's numbers to January's, you'd think the business was falling off a cliff. But if you compare April of this year to April of last year, now you're getting the real story.
Okay, detective, we've gathered our evidence. Now, in Section 4, it's time to analyze it. And don't worry, you don't need to be a math genius for this. We just need one simple formula to unlock the truth that's hidden inside these numbers.
Here it is. This little formula is the key to the whole thing. To get the growth rate, you just take the number from the recent period. You divide it by the number from the same period a year ago, and then you subtract 1. That's it. Seriously. Let's see it in action.
So, our case file for today is the big pharmaceutical company Pfizer. We've pulled the evidence right from their report. You can see their sales in the last quarter were just under $13 billion. And in the same quarter a year ago, they were closer to $14 billion. Okay, got the numbers? Let's plug them into our formula. Okay, so we take the recent sales, 12,973, divide by the year ago sales, 13,968, and then subtract 1. And boom, the result is negative 0.07. Or, put simply, negative 7%. Our first clue is officially in. Pfizer's sales didn't grow. They actually shrank by 7% compared to last year. Now that is a critical piece of evidence.
But you know what? One clue is never enough to solve a case. In Section 5, we're going to do what all great detectives do. We're going to connect the clues to see the whole story. This is where the numbers stop being just numbers and start telling you something important.
And we're going to use a simple 3-step framework. First, we'll look at different numbers, like sales versus profits, from the same period. Second, we'll track one number over time to see if we can spot a trend. And third, we'll see how our company stacks up against its rivals to get some much-needed context.
All right, step 1. We already know Pfizer's sales dropped 7%. But wait a minute, look at this twist. Its per-share earnings, that's the profit, grew by 17%. How is that even possible? How can sales go down but profits go up? Well, it's a huge red flag. It tells you that profit probably didn't come from selling more stuff. It most likely came from cutting costs, and that is not a sustainable way to grow a business.
Now for step 2, let's look at that earnings growth over time. Okay, so in the last 12 months, growth was a massive 26%. That looks pretty good, right? Well, hold on. When you zoom out and look at the last 4 years, it was only 1% a year. And when you look forward, analysts are only expecting about 5%. So what does that tell you? It tells you that recent jump was probably a one-time blip, not the start of some amazing new trend.
And finally, step 3, how does Pfizer look compared to the competition? As you can see, that 10% sales decline over the last year, it wasn't just a Pfizer problem. Merck and Eli Lilly also saw their sales drop. This suggests there's probably a bigger issue affecting the whole industry, not just a problem inside this one company.
Okay, we've collected the evidence, we've cracked the numbers, and we've connected the clues. It is time to step back, look at all the facts, and deliver our final verdict on the Pfizer case file.
So here's the summary. That weird gap between falling sales and rising profit, it screams cost-cutting. That big spike in profit, it looks more like a short-term blip than a long-term trend. And when you put it next to his rivals, Pfizer is just average. So, the final verdict? Based on this investigation, there is no big, exciting growth story here. Case closed, for now.
So there you have it. You now have the tools to be a growth detective. But you know how it goes. You solve one mystery, and another one pops up. Just because a company is growing, does that mean it's growing well? The next case file is already open, figuring out if a company actually knows how to grow efficiently. But that's a story for another time.
All right, let's get right into it. You know how everyone always says to look for companies with booming sales? Well, what if I told you that's only half the picture? Today, we're going to solve the other half of the puzzle, profitability. That's the real secret to finding a truly healthy company. I mean, look at this. Any company can make its sales numbers look good if it just throws enough money out the window. But if it costs you $100 million to bring in $80 million, you're not growing. You're just shrinking in a very expensive way. And that's something savvy investors know to look out for. You know, the easiest way to think about it is just like your own budget at home. Your paycheck might be huge, but if your bills are even bigger, well, you've got a problem, right? Profitability is all about what a company actually gets to keep, what's left in the bank to grow the business, or, to finally book that trip to Disney World. So yeah, this gets us to the heart of it. We've got to look past those flashy sales numbers and understand why profit is the true vital sign of a company's health. It tells you everything about how well the company is actually being run. So what do we even mean by profitability? Well, it's just a fancy word for efficiency. It's a measure of how good a company is at turning all of its sales, all of its resources, the factories, the people, the whole shebang, into cold, hard profit. To figure this out, we're going to need a few tools in our toolbox. The first set of tools are what we call profit margins. These let us play detective and follow the money as it trickles down the income statement, starting from the very top line, that's total sales, all the way down to the famous bottom line. And there are three main ways to look at this. First up, you've got gross margin, which tells you how much money the company makes just from selling its product, before any other costs. Then there's operating margin, which shows the profit after you factor in the costs of actually running the business. And finally, the big one, net margin. That's the pure bottom line profit after every single expense is paid. Now, this might look like math homework, but stick with me. It's actually super simple and incredibly powerful. The most important one is net profit margin. You just take the company's net income and divide it by its sales. What that gives you is a simple percentage that tells you exactly how many cents of profit a company keeps for every dollar it makes. Let's use a real example to make this stick. So back in 2013, the defense contractor Honeywell had a net profit margin of 8.4%. What does that mean? It means for every single dollar in sales it brought in, it got to pocket 8.4 cents as pure profit. Okay, on to our next set of tools. Margins are great for telling us about sales efficiency, but our second tool set looks at the balance sheet. It answers a totally different but just as important question. Is the company making the most of the stuff it already owns? And the first metric we use here is called return on assets, or ROA for short. This formula is brilliant. It takes the company's net income and compares it to all of its assets. That's its cash, its inventory, its factories, all of it. It basically asks the company, hey, how much profit are you squeezing out of all the stuff you own? For Honeywell, that number was 7.7%. So for every dollar's worth of assets on their books, they were generating 7.7 cents in profit. That's a really powerful snapshot of how efficiently the business is being run. Now, for the one that shareholders, the actual owners of the company, really care about, return on equity, or ROE. This ratio cuts right to the chase. It takes that net income and divides it by what's called shareholder equity, which is basically just the company's net worth, the part the shareholders truly own. And check this out. This is where Honeywell really shines. Their ROE was a whopping 24.3%. Let that sink in for a second. For every single dollar that stockholders had invested in the company, the management was generating over 24 cents in profit. Now that is making your money work for you. Okay, so now we have our tools. We've got margins, ROA, and ROE. But a bunch of numbers floating in space are pretty much useless, right? We need a game plan, a simple framework to put them all together so we can actually make a smart decision. And luckily, it's a really straightforward three-step process. First, you look at the recent trends. Is profitability headed up or down? Second, you zoom out and compare that to the company's own history. Is this a new thing, or is it just business as usual? And third, and this part is absolutely critical, you've got to see how they stack up against their direct competitors. And this is where that third step really comes to life. When we put Honeywell's 7.7% ROA side by side with its biggest rivals, like Lockheed Martin and Raytheon, you can see it's just a little bit ahead of the pack. That tells us that during this period, Honeywell was running its business just a tad more efficiently than its competition. But, and this is a really big but, you have to be careful. Numbers don't always tell the full story. Just like this quote says, even a powerful ratio like ROE can be incredibly misleading if you don't take a second to understand the why behind it. This is a perfect example. Check out Lockheed Martin. Their ROE shot up to an insane 275%. You'd think they were printing money. But it wasn't because profits went through the roof. Nope. It was because the equity part of the formula, the part the shareholders owned, actually shrank. So the final number looked amazing, but the story behind it was, well, a whole lot more complicated. And that's exactly why context is everything. You can't just pluck one number out of thin air and call it a day. You have to look at trends. You have to look at the timing. You have to understand the bigger picture. I mean, think about a retailer like Macy's. Of course their profits are going to spike during the holiday shopping season. So comparing their holiday quarter to a slow summer quarter, that's completely pointless. It's apples and oranges. You have to compare this year's holiday quarter to last year's holiday quarter. That's how you see the real trend. So let's bring it all the way back to Honeywell and piece this story together. What did we learn? 1. Its profitability got a whole lot better over the last year. That's great. 2. It started operating more efficiently than its competitors. Also great. But 3, that rate of improvement started to slow down, which might suggest that it's reaching a peak. See? It's a story with a beginning, middle, and a potential twist. And that right there is the single most important thing to take away from all this. These ratios, they are not a magic formula. They don't flash a big green buy sign or a red sell sign. They are clues. They are storytelling tools. And your job as an investor is to be the detective who pieces that story together. Which leaves us with one last big question to chew on. What kind of story do you, as an investor, want to bet on? Are you looking for the reliable company that is a profitability machine right now? Or do you prefer the high-stakes drama of a company that's burning cash today for a shot at total domination tomorrow? There's no right answer, but knowing your answer, well, that's what makes you an investor.
So, you've learned all the lingo for analyzing stocks. PE ratios, growth metrics, all that stuff. And then you're left standing there thinking, okay, now what do I actually do? Sound familiar? Well, that's exactly the gap we're going to bridge today. We are turning all that theory into a real, practical framework for how to spot potential winners out in the wild.
Exactly. You've put in the work, you know your stuff, you get the difference between revenue and profit, but then you pull up a stock screener and bam! Thousands of companies are just staring back at you. It's totally paralyzing, right? So how do you go from knowing the terms to actually making a decision you feel good about? That is the puzzle we are solving today.
All right, so the first big idea, and this is absolutely crucial, is that you have to look at any company through 3 different lenses. You've got valuation, you've got growth, and you've got profitability. Think of it like a 3-legged stool, you know? If one of those legs is weak, let's say it's growing like a weed but losing a ton of cash, that whole stool is going to topple over.
That's it exactly. I mean, looking at just one of these metrics, it's like trying to watch a 3D movie without the glasses. You can kind of see what's happening, but you're missing the whole point, all the depth. You only get the full picture of a company's health when you layer all 3 of these views together.
Okay, so that's the framework. But before you can analyze a single thing, you actually need some ideas, right? I mean, there are thousands of public companies out there. Where on earth do you even start? It really can feel like you're just staring at a blank screen. So let's talk about a few simple ways to get from that blank page to an actual short list of stocks to check out.
So here are 4 pretty straightforward ways to get inspired. First, you could just look into a stock that an analyst or an investor you trust has recommended. Simple. Second, you could look at companies you already know and understand from your own life, maybe from your job or even a hobby. Third, you could pick an entire industry you're excited about, like, say, AI or something, and then dig into the top companies in that space. And fourth, you can just follow experts in media that focus on your preferred style, whether you're a value hunter or a growth investor.
And that second one, invest in what you know, that's straight from the playbook of the legendary Peter Lynch. Seriously, don't underestimate the expertise you already have. Think about it. Maybe you're a nurse and you see a new medical device that's a total game changer. You get why it's better in a way some analyst in an office just can't. That's your secret weapon. Okay, so now you've got a few companies on your watch list. This is where the real fun begins. And here's the thing. Picking stocks isn't like a video game where you just look for the highest score in one stat. Not at all. It's this great balancing act. All these metrics are in a constant push and pull with each other.
Let's take valuation, for example. It's so easy to see a stock with a low price-to-earnings ratio and think, wow, what a bargain.
It's like seeing something on the clearance rack. But you gotta ask yourself, why is it on clearance? Sometimes things are cheap for a very good reason. That low price might be a huge warning sign that there are serious problems hiding just under the surface.
And this is where it gets really interesting. This tug of war between growth and profitability. It's a classic trade-off. You'll see a company with just, mind-blowing revenue growth, but then you peek behind the curtain and realize they're just torching cash to make that happen. They're spending $1 to make 80 cents. Then you've got the opposite, a company that's super profitable, but how are they doing it? Maybe by gutting their R&D budget, which, could totally kill their long-term growth.
So here's the bottom line. That perfect stock, the one that's super cheap, growing at an insane rate, and is wildly profitable, it's basically a unicorn. It just doesn't really exist. They are so rare. And if you sit around waiting for that perfect stock to fall into your lap, you're going to be waiting forever. The real winners, the ones you can actually find, are the ones that are just really good in a couple of those areas.
Okay, that's a lot of theory. How do we make this practical? Let's distill all of this down into a few simple rules of thumb. Think of these as a quick checklist. The key signals to watch for when you're looking at a company.
All right, let's run through them. First, by all means look for cheap stocks, but always ask why it's cheap. Is it a hidden gem or a sinking ship? Second, high growth is awesome, but you have to check if it's profitable growth. Is it sustainable or is it just fumes? Third, you have to be realistic. Demanding incredible growth and a bargain bin price is going to mean you have very few options to choose from. Fourth, if profits are soaring, that's great, but just double check that they're not achieving that by starving the parts of the business that will create future growth. And last but not least, number 5, just be wary of extremes. If a stock looks too good to be true, it probably is. The market isn't always wrong. Okay, deep breath, you've done the homework, you've found some ideas, you've balanced the pros and cons, you've checked for red flags. Now what? Now it's time to actually make a call. And this last piece of the puzzle is really all about your mindset.
So we're back where we started, with all this conflicting info, all this gray area. How do you actually spot a winner?
Here's the secret. You stop looking for the perfect stock. It's a trap. It doesn't exist. I'm telling you, every company has warts, every single one. If you wait for perfection, you'll never invest a dime. Your real target isn't perfection. It's a potential winner. You're looking for a company that is really solid in most areas, with maybe a few flaws that you actually understand and are okay with.
And really, that's the main thing to remember here. Your goal isn't to find a flawless diamond. It's to find broad-based excellence. Don't get hung up on one tiny flaw and miss the bigger picture. You're looking for a company that's just strong, solid, and well-rounded. That's what really matters in the long run.
So look, the analysis is done. The choice is yours. You have the framework now. You know what to look for. You know how to weigh the different pieces of the puzzle. You're ready. So, are you ready to pounce? Okay, so you've done all the math. The numbers look good. The growth is there. The valuation. It all seems right. You've crunched the data until your eyes are blurry. But what if I told you that was the easy part? Yeah, because once all that quantitative analysis is done, the real work of understanding a company, well, that's just getting started.
So there it is, the one. A stock that checks every single box you have. I mean, the fundamentals look absolutely unshakable, and you're just hovering over that buy button. But there's that nagging little question in the back of your head, isn't there? Now what? How do you actually make that leap from being a smart analyst staring at a screen to becoming a truly wise owner of a piece of a business?
And this is why. This is where the spreadsheet ends and the story really begins. Look, a financial statement can tell you where a company's been, but it can't tell you everything about its culture or its competition or, the storm that might be brewing on the horizon. To really succeed, you have to look beyond the numbers. You've got to understand the business behind the ticker symbol.
So before you invest a single dollar, let's get your toolkit ready. We're going to walk through 5 essential qualitative steps, the kinds of things that separate the casual speculators from the really serious investors. So what's in this toolkit? Well, first up, you have to be in the know. That means following the company's own press releases, sure, but also keeping an eye on what's being said about their biggest rivals. It gives you context. Second, get yourself a high-quality source of financial news. The Wall Street Journal is the classic for a reason. It helps you connect your company to the bigger economic story. Which brings us to number 3, and this one's my favorite. You have to actually read it. Seriously, it's not just a prop to make you look smart at the coffee shop.
Engaging with it helps you understand the bigger tides that can lift or sink all the ships in the harbor. And finally, bring a big, healthy dose of skepticism.
This old saying just nails that fourth point, doesn't it? Whether you're watching cable news or scrolling through your social media feed, you've got to remember that pretty much every pundit has an angle or a position they're trying to defend. Their insights can be valuable, for sure, but you always have to filter them through your own research and your own critical thinking.
And here it is, the golden rule. This is the most important tool in the entire kit, so listen up. Seriously, let this one sink in. It doesn't matter how confident the source is, how popular the influencer is, or how amazing the story sounds, never, ever act on a stock tip without doing your own homework first. Their conviction is not and never will be a substitute for your own. Okay, so now your toolkit is ready, and you've made an informed purchase. The whole game changes. And this analogy just illustrates the new mindset you need perfectly. Think about it. When you vote for a politician, you're pretty much stuck with them for a few years, right? For better or for worse. But with a stock, you hold all the power. If the company's leadership makes a bad call or the story you invested in changes, you can impeach them in an instant just by selling your shares. You are always in control. So you've clicked buy. The transaction's done. But this isn't the finish line. Not even close. This is the starting gun. The work of an informed buyer might be over, but the journey of a wise owner, that's just beginning. I really love this quote because it frames the mindset perfectly. Managing a portfolio isn't about one single decision. It's this ongoing process of monitoring and learning and sometimes adjusting your course. Every investment you make is really just one stop on a much longer journey toward your financial goals. So what does this journey actually look like day to day? Well, it really boils down to a few key habits. First, track your portfolio, say, once a week. You want to stay informed, but you don't want to drive yourself nuts reacting to every little daily flicker. Second, if a stock drops, your job is to become a detective and find out why. Knowing the reason is the only way you can make a smart next move. Third, if a stock makes a big move, we're talking up or down more than 10%, that's your signal to reassess. Ask yourself, does my original reason for buying this thing still hold true? And fourth, every quarter, revisit the company's financials. Think of it as their official report card. It tells you if the story you bought into is actually still playing out. All right, let's put this into practice. Imagine you log into your account and you see one of your stocks is down 5% for the week. That immediate gut feeling is that red, sinking, panicky feeling, right? We've all been there. But a wise owner doesn't react. They investigate. So what's the very first step?
Here's your simple diagnostic test. First thing you do is zoom out and look at the whole market. Is everything down? If the S&P 500 is down, the Nasdaq's down, chances are your stock is just caught in a broader current, and you can probably just relax. But if the market is flat or maybe even up, and only your stock is sinking, that's your signal. That's your cue to put on your detective hat and find out what's really going on with that specific company.
Which brings us to our final section. We've talked about what to do before you buy and what to do while you own it. Now we're going to talk about the hardest part. This really is the ultimate test of your discipline as an investor.
What I'm about to tell you, it sounds incredibly simple on the surface, but trust me, when your own hard-earned money is on the line and emotions are running high, actually doing this is one of the most difficult things in all of investing.
And there it is. Don't overreact. When those negative headlines flash across your screen, a missed earnings target, a lawsuit, a scary new competitor, your primal instinct, your gut, is to slam that sell button to make the pain stop. But that knee-jerk emotional reaction is almost always the most expensive mistake you can possibly make. So how do you stay rational when everyone else is panicking? Here's a little framework. First, only focus on news that fundamentally affects the company's ability to operate and make money. A new product failing, that's huge. A CEO's embarrassing tweet? Probably not. Second, try not to get too worked up over most legal battles. They're super common, they often take years to resolve, and the market usually prices them in pretty fast. Third, respect the market. The crowd isn't always right, but if you're going to bet against it, you better have a deeply researched, high-conviction reason. And finally, and this is so important, remember there's no shame in selling. If the facts have changed and you've genuinely lost faith in the company's future, selling is the smartest thing you can do. It's a strategic decision, not an admission of defeat.
So I'll leave you with this one question, because it really gets to the heart of everything we've talked about today.
Are you going to be an active, wise owner, someone who investigates, reassesses, and makes deliberate choices based on a clear strategy? Or are you going to be a passive spectator, just getting tossed around by the headlines and your own emotions? The portfolio you build will be the answer.
Welcome to The Explainer. Today, we're basically going to hand you the keys to your own investment journey. Think of this as your personal driver's manual for navigating the stock market.
Okay, so here's our game plan. First up, we got to pick your car. That's your broker. Then we'll get you comfortable with the controls. You know, how to actually place a trade. After that, we'll teach you how to read the road signs, what a stock quote really means. And to wrap it all up, we'll talk about planning for those inevitable tolls on the road. Yep, I'm talking about taxes.
All right, first things first. You can't go anywhere without a car, right? Well, in the investing world, your car is your broker. They're the ones who actually make the trades for you and hold on to your investments. So yeah, picking the right one, kind of a big deal.
And look, this is a question that I know is on a lot of people's minds. I mean, you're about to hand over your hard-earned cash, so you got to know, is it actually safe with some company you found online?
The short answer, and this is a relief, is a big yes. And that's thanks to organizations like the SIPC. Now think of it like this. It's insurance against a shady broker, not against you making a bad investment. So it won't save you if a stock you pick goes down, but it absolutely protects your money from fraud or theft. And honestly, that's huge peace of mind. So when you're shopping for a broker, you're basically looking at two main models. On one side, you have your discount brokers. Think of these as your reliable, no-frills sedan. The deal is you're in the driver's seat, making all the calls. On the other side, you've got your full-service brokers. These guys are like the luxury car that comes with a chauffeur. They'll give you advice and handle stuff for you, but as you can imagine, you're going to pay a much, much higher price for that premium experience.
So here's the thing. There's really no single best broker out there. The only thing that matters is finding the best broker for you. So as you're looking around, you've got to ask yourself a few questions, like, do they have a minimum account size I can meet? Is their website actually easy to use, or is it a total headache? Are you going to be trading a lot? And do they even offer the kinds of investments you're interested in? The key is to find the one that checks all your boxes.
Okay, so you've picked out your car. Awesome. Now it's time to actually learn how to drive this thing. We're talking about the absolute basics. The gas, the brake, the steering wheel of trading. Let's get into the different ways you can actually buy and sell stocks.
You've basically got three main controls here. First is the market order. This is your gas pedal. You hit it and you go right now, buying or selling at whatever the best price is at that exact moment. Then you've got the limit order. This is like your cruise control. You set a very specific price and the trade only goes through if the stock hits that number. And finally, there's the stop order. Think of this as your emergency brake. It automatically sells your stock if it drops to a certain price, which can really help protect you from a major loss.
Awesome. We're officially on the road. But you know, to get where you're going, you need to know how to read the signs. In investing, all those signs are packed into what's called a stock quote. So let's break down the most important parts.
Okay, first up, the ask price. It's pretty simple. This is the lowest price any seller out there is currently asking for the stock. If you're going to place a market order to buy, this is pretty much the price you should expect to pay.
And on the flip side, you've got the bid price. This is the highest price any buyer is willing to bid or offer for that same stock. So if you sell at the market price, this is what you'll get. And that little tiny difference between the bid and the ask, that's called the spread. A smaller spread is usually a good sign. It means the stock is pretty easy to buy and sell.
And last but not least, we have volume. This just tells you how much traffic there is for this stock today. A super high volume means tons of shares are changing hands. Lots of people are interested. Low volume, well, that means it's a pretty quiet day on that particular road.
Okay, we're getting near the end of our road trip, but every trip has its costs, right? You got to plan for tolls. In the world of investing, those tolls are taxes. And trust me, ignoring them can be a really expensive mistake. So let's figure out how to plan for them.
But first, a really critical piece of advice. You'll hear people say, don't let the tax tail wag the investment dog. And what that means is you should never make a bad investment decision just because you're scared of paying taxes. Look, the whole point is to make a profit. Paying tax on that profit, that's actually a good problem to have.
When it comes to taxes, time is definitely your friend. If you sell a stock you've owned for less than a year, any profit gets taxed at your regular income tax rate, which is, higher. But if you hold on to it for more than a year, that same profit gets taxed at the much lower long-term capital gains rates. Patience literally pays off here.
So how can you protect your investments from these yearly tax tolls? Well, one of the best ways is with an individual retirement account, or an IRA. Think of it as a special garage where you park your investment vehicle. Inside that garage, your investments can grow and compound year after year, and you don't have to pay a dime in taxes on the gains. You only pay taxes way, way down the road when you finally take the money out in retirement.
And then there's the absolute superstar of retirement accounts, the Roth IRA. Now, with a Roth, it's a little different. You pay the taxes on your money today, before you put it in. So why on earth would you do that? Well, if you think you'll be earning more when you retire, paying the taxes now could save you a ton of money later. And here is the magic part. All of that growth, every single penny of profit you make over the decades, can be withdrawn completely 100% tax-free in retirement. It is an incredibly powerful tool.
All right, last stop on our tour. What about that 401k plan your job is always talking about? Is it really worth signing up for? Let me make this super clear. The answer in pretty much every single case is a huge, flashing neon sign, yes.
And here's the simple math on why. Let's say you make 50 grand a year. A lot of companies will offer a match. A really common one is they'll match 50% of your contributions up to 6% of your salary. So you put in 6%, that's $3,000, and your company just gives you an extra $1,500, just like that.
And this is why it matters. This is the closest thing to free money you will ever see in your life. Seriously, not contributing enough to get that full company match is literally like turning down a raise. It's an instant 50% or even 100% return on your money, completely guaranteed. You will not find a better deal than that, anywhere.
So there you have it. You know how to pick your car, how to use the controls, how to read the signs, and how to plan for the tolls. The driver's manual is officially in your hands. The only question left is, where do you want to go first?
You know that feeling, right? When you find that one winning stock, it's just incredible. It makes you want to dive right back in and find the next big thing. And hey, that enthusiasm is awesome, but it can actually lead you down a path that's, well, surprisingly risky. So to really get why, let's try and think about investing in a totally different way. I want you to imagine something with me. Picture the entire stock market as this massive, sprawling supermarket. You can buy literally anything you want. But it's totally up to you to figure out what actually makes a balanced meal, or in our case, a balanced portfolio. So you're strolling down the aisles and then you see it. A huge sign, a massive sale on your absolute favorite soup. The store just ordered way too much and now it's a whopping 25% off. This, right here, this is that winner stock you found. It feels like a total steal, so of course, you start loading up the cart. But then you look around, and everything else is full price. You've got your budget for the week, so what's the move? Do you spend all of your money just stocking up on that one amazing deal? I mean, come on, you love this soup, and it's super cheap. Why would you buy anything else? And you know, this exact dilemma, it's where a ton of investors trip up. Which brings us to our first big idea. What happens when we really treat the market like a supermarket for stocks? Let's be real, in the grocery store, you would never, ever go home with only soup. You know you need other stuff. Bread, eggs, some vegetables, a balanced diet. But for some reason, when it comes to investing, this whole load up on the best deal strategy is incredibly common. An investor finds a great tech stock like Cisco, and next thing you know, their whole portfolio is Microsoft, Apple, and Google. Now, those are all fantastic companies, don't get me wrong, but it's the investment's equivalent of an all-soup diet. So what's the big deal with this all-soup diet? Well, it creates a very specific problem for investors, and that's exactly what we're going to dig into next. Seriously, just picture it for a second. Open your pantry doors, and it's just wall-to-wall soup. Cans everywhere. Now, you might feel like you've got a great stockpile, but what you've really done is create a very, very specific menu for yourself. And that's the core of the issue, right? Soup is perfect when it's cold and windy outside. But when it's a scorching hot summer day, the absolute last thing you want is a bowl of hot soup. But that's all you've got. A portfolio that's loaded up on just one type of stock, like tech, is exactly the same. It's built for only one kind of market weather. The solution to this is a beautifully simple idea. It's called diversification. And all it really means is building a portfolio that can handle all kinds of weather, the good times and the bad, just like a well-stocked pantry that has food for any season. Okay, a well-stocked pantry sounds amazing, but how do we actually build one for our investments? Let's break it down into 3 really practical ways you can do it. Look, the game plan here is actually pretty simple, and each step builds on the last. First, you just buy multiple stocks, not just one or two. Second, you make sure those stocks are from different industries. And third, you go beyond stocks altogether and bring in different types of investments. Let's dig into what that actually looks like. So first up, aim to own somewhere between 25 and 35 different stocks. Now, why that specific number? Well, if you have too few, just a couple of stinkers can really wreck your whole portfolio. But if you own too many, you might as well just buy an index fund. That range, 25 to 35, that's kind of the sweet spot for getting a great blend of risk and return. Step 2, whatever you do, don't just buy 25 tech stocks. You've got to spread them out across different parts of the economy. Think about stuff your family always needs, no matter what, like groceries. That's a sector called consumer staples. Then think about the companies that power our world, energy, or the banks that handle all our money, financials. By owning stocks in at least 6 different sectors like these, you make sure your portfolio isn't betting the farm on just one part of the economy. And finally, strategy number 3 is to buy completely different kinds of investments. The classic example here is stocks and bonds. See, stock prices tend to go up and down based on a company's profits, but bond prices, they're usually more influenced by things like interest rates. The point is, they often dance to a completely different rhythm, which is exactly what we want. All right, this all sounds great in theory, but here's the real question. Does it actually work? Well, let's look at the data, because the proof is right there in the numbers. Okay, before we dive into the numbers, there's just one little term we got to get our heads around: correlation. It's just a score that tells you how two investments move in relation to each other. A score of 1 means they move in perfect sync, like synchronized swimmers. A score of 0 means their movements have nothing to do with each other. Now check this out. Look at the correlation between large company stocks and small company stocks. It's 0.72. They move pretty closely together. But now look at the number for large company stocks versus long-term government bonds. It's just 0.06. That is incredibly low. It shows you clear as day that these two things really do march to the beat of their own drum. Okay, so they move differently, big deal, right? Well, what does that actually mean for your money? This table right here shows us exactly how mixing them together changes the game for your risk and your return. I want you to look at the column on the far right. It's called return per unit of risk. This is the magic number. A portfolio with 100% stocks gives you a score of 0.58. But watch what happens as we start adding bonds. The number goes up, and the peak, the absolute most bang for your buck in terms of risk, is right here at 0.85. And what's that portfolio made of? 30% stocks and 70% bonds. You're getting more return for every bit of risk you take on. So what's the big takeaway here? It's crystal clear. By adding an investment like bonds, something that doesn't move in lockstep with your stocks, you can seriously lower your portfolio's overall risk, all while keeping your returns pretty solid. You're basically smoothing out the ride. All right, so we've talked about the why, and we've seen the proof in the numbers. This brings us to our final and maybe the most important section: how you can take all these ideas and actually start building your own diversified portfolio. Look, there's no magic wand here. There's no way to guarantee you'll avoid every single storm in the market. But the single most important thing to take away from all this is simple. With a diverse portfolio, you dramatically decrease your risk of losing big. You're building that pantry that can feed you no matter what the weather is like outside. And that really just leaves us with one final thought. We've gone all the way from soup cans to correlation charts. We've covered the why and the how. The real question now is, what are you going to put in your cart? What questions are you going to ask to build your perfect portfolio? All right, let's talk about building your very own investment portfolio. I know, it's one of those things that can feel huge, right? Super complex. If you've ever felt kind of lost in all of it, trust me, you are so not alone. I mean, it's the million-dollar question, isn't it? You're staring at all these options, all this jargon, all these numbers, and it is so easy to just freeze up. You start wondering, is there some secret formula I'm missing? Some magic stock tip? Well, here's the good news. The answer isn't some complicated market secret. It's actually all about you. A truly great strategy begins with asking yourself a few key questions. So, let's dive in. We're going to walk through 4 really important questions. And listen, there are no right or wrong answers here. They're only your answers. And those answers, They are going to become the blueprint for your entire financial plan. First up, and this one is absolutely critical, how much is enough? It sounds almost too simple, doesn't it? But this is the single most common and honestly the most dangerous mistake investors make. They just don't have a number. And without a target, you're basically flying blind. And this is why that question is so important. $1 million sounds like a ton of money, right? But just look at this chart. If you're spending $120,000 a year in retirement, that $1 million nest egg vanishes in just 12 years. Whoa, that really puts things into perspective, doesn't it? Okay, next up, when are you going to need this cash? We're talking about your time horizon. Is this for retirement in 30 years or maybe a down payment on a house in 5? The answer completely changes the game because it tells you how much risk you can really afford to take. The shorter the timeline, the more conservative you need to be. And this slide just illustrates that perfectly. Take a look at the historical data for stocks. If you only have 5 years, there was a 14% chance your money was worth less than when you started. But stretch that out to 20 years. Historically, there has never been a 20-year period where stocks lost money. Time, my friends, is your secret weapon against market volatility. All right, question 3. This one brings it all back home. How much can you actually set aside on a regular basis? Look, the single most important key to building wealth has nothing to do with picking some genius stock. It's about a simple habit: spending less than you make. That difference, that gap, that's your superpower. And you don't have to be a millionaire to get started. I love this slide because it's so encouraging. Just look at what happens with $500 a month. You consistently invest that, and in 30 years, it could grow to more than $679,000. That right there is the beautiful, beautiful magic of compounding. And finally, our fourth question is a real gut check. How much risk can you personally handle? I'm talking about your sleep at night factor. Because if your portfolio is bouncing all over the place and it's making you anxious, then it is not the right portfolio for you. Simple as that. The best plan is the one you can actually stick with when things get choppy. Okay, so we've asked the big, personal questions. Now for the fun part. Let's get down to brass tacks and turn those answers into a hard number that you can actually aim for. Now, don't let the math on this slide freak you out, I promise. It's way simpler than it looks. We're just trying to find your required rate of return. That's just a fancy way of asking, what annual return do I need to get from point A to point B? So let's walk through the example. Let's say you have $100,000. You need $1 million, and you've got 25 years to get there. You plug those numbers into that little formula, and boom, there it is, 9.6%. That is your target. It means you need your investments to grow, on average, by 9.6% every single year for 25 years to hit your goal. That number, that's your new North Star. So the big question is, how do we actually build a portfolio that's designed to hit that 9.6%? Well, it all starts with something called asset allocation. Basically, deciding your mix of stocks and bonds. And there's a really simple rule to get us started. This is a classic, a great starting point. Just take the number 110, subtract your age, and that result, that's roughly the percentage of your portfolio you should think about putting into stocks. So if you're 40 years old, that's 70% in stocks. The other 30%, that would usually go into something safer like bonds. But hey, that's just the start. You've got to fine-tune it. And this is where your answers to those 4 questions come back into play. If you're a risk taker, maybe you bump up that stock percentage by 10%. If you're a bit more cautious, maybe you dial it back by 10. It's all about tailoring this to fit you. All right, this is the moment of truth. This is where the rubber meets the road. We know the return we need, and we've built a portfolio we think will work. Now we have to ask the big question. Is our plan actually realistic? And to do that, we have to use the right numbers. So here's a quick but really important point. We're not going to use average returns because those can be kind of misleading. We're using what's called annualized returns. They give a much truer picture of growth over time. And historically, stocks have given us about 10% annualized, with bonds coming in around 6%. So now we can figure out our portfolio's target return. Let's go back to our 40-year-old with that 70-30 split. You just do the math. 70% of your portfolio aiming for 10%, plus 30% aiming for 6%. Add it all up, and you get a target return of 8.8%. And this is it. This is the single most important comparison you will make. In our example, the person needs 9.6%, but their plan is only likely to deliver 8.8%. See that? There's a gap. And seeing that gap is incredibly powerful. It tells you right now that something needs to change. You either have to save more, take on a bit more risk, or adjust that final goal. Now, before we wrap up, we've got to talk about what can go wrong, because even the best plans can get derailed. So let's quickly cover 4 common pitfalls you need to watch out for. Okay, let's run through these. First, don't expect crazy returns. Getting more than 10% year after year is really, really hard. Second, never forget about inflation. That sneaky 3% a year really eats into your buying power. Third, life happens. You've got to have a cushion for the unexpected. And finally, play it safe. It's always better to plan on needing a little more money and living a little longer than you might think. And you know, that really says it all. This whole thing isn't about daydreaming or wishing for some magic number. It's about taking a clear-eyed look at your reality and building a solid, realistic plan to get where you want to go. That's where true financial empowerment comes from. Because really, this journey never stops. It's something you'll revisit and adjust over time. You now have the framework, you have the questions to ask, so the only real question left is, what's your next step going to be?